Okay, well, welcome everyone here. So they pretty much did the bio on me here, so I guess I can skip that part. So yes, I'm a Buddhist trader and philanthropist, and so I actually did my kind of trading career in reverse. A lot of people work on Wall Street for a long period of time, make a lot of money, and then they kind of have some sort of existential crisis, and then they feel like they need to do something with their life or meditate or do yoga or something like that. I did it in reverse. So I actually had zero training in finance or business or economics. I didn't take a single business class in college. I was a neuroscience and philosophy major. And so when I started trading, I had no trading in economics, finance, business, or anything. And I had already been doing yoga and teaching yoga and practicing meditation for years at that point. So I kind of did something in the reverse order, I guess you can say. And I think that allows me a unique perspective. So what I'm going to be talking about today, and let me bring up my PowerPoint real briefly, is that I trade Forex, futures, CFDs, options, commodities. I trade everything across the board. And my main method for attacking the markets and trading all markets, it doesn't matter the market, doesn't matter the instrument, doesn't matter the time frame, I approach the market through price action, particularly price action context. And so what I'm going to be talking about today is my core model of understanding price action context. So I actually teach price action context based on a triangle model, and I'll be explaining one portion of that triangle today in today's lesson. So since we've already done the whole bio, I guess I can skip past that. All pretty much been stated before. So in the FX market, and pretty much in most markets, order flow is going to be the most proximate driver of price action. There can be various reasons why people are putting on positions. It could be fundamental reasons or macro reasons. There can be technical reasons, such as we're hitting a double top or a 200-day simple moving average. There can be flow reasons, such as, hey, George Soros is shorting the Aussie dollar. He put in a $2 billion position on this. There's a good chance that a lot of flow is going to tack on with that. Or there can be necessary reasons that people are putting flow into the FX market. And that could be international corporations that need to hedge, like in Japan. That's a big issue right now. A lot of the actual flow we're seeing out of the dollar yen right now is from international corporations that had to hedge with the massive appreciation in the Japanese yen this year. So whatever the reason is for any one of these various institution players putting their trades on in the market, the bottom line is, whether it's fundamental, whether it's technical, whether it's flow driven or necessary, all of those positions have to get converted into order flow. If they're not, they're just potential liquidity. Once they become actualized order flow, then they become a proximate driver for the price action in the market. In the FX markets, for those of you that don't know, the bottom line is the market is very opaque. It's not transparent. So you cannot actually see all the order flow that's happening in the market, and very few players in the market actually can. And even then, it's decentralized, so you can't even see all the different order flows that are happening across the market. So in the FX market, it's a game of information, and it's asymmetrical, meaning that you don't get access to a lot of the information that is available that could help inform your trading decisions. And so because of that, I look at the closest footprint to order flow, and that's price action. And I approach that through price action context and understanding the structure of the price action. So through price action context and the structure, that can reveal to me the underlying order flow in the market and what is the most probable scenario in terms of the order flow out there. My main core model for doing that, which we'll be talking about today, and I'll be getting into charts to explain this, is an impulsive versus corrective price action. And I'm going to describe how you can identify this on any instrument, any time frame, or any environment. And I'm going to be going over some examples of how you can use this model to set up the basis of your price action context read, and how you can use this model to determine the level of balance or imbalance in the price action. Does everybody know what I'm saying when I say level of balance and imbalance in the order flow? Yes, no? Okay, some people don't. Okay, so if order flow is the proximate driver of price action, then when we have very clear, decisive with trend moves, in pretty much all the cases, that's going to happen due to a high level of imbalance on the order flow to one side of the market, to the buy side or the sell side. Since I am a directional trader, that means that I'm looking for situations and environments where the level of imbalance is most favorable to the direction that I'm trading, and the level of balance is the least amount against the direction that I'm trading. So that doesn't mean I can't trade balanced environments or balancing zones or anything like that. In fact, no, I can trade those quite well. But when I am looking to be long a particular position, or right now I'm short dollar yen, I'm looking for the imbalance to be more towards the sell side than the bottom side. And the good thing is that level of balance and imbalance can be reflected in the price action. Now, Shyamala had a question here saying demand and supply. It's actually not quite like that. And if you look at how the FX market works, it doesn't really quite work like that because the liquidity is so deep. Issues of supply are never really an issue. There's so much liquidity. It's rare that we ever exhaust the amount of liquidity in the FX market. That would apply more for certain markets like futures or equities. But in the FX market, because the liquidity is so deep, demand and supply don't quite, at least when you're trading spot, don't quite apply in this case here. So let me get into some actual charts here, and so we can start looking at what do I mean by this and how you can identify it. So an impulsive move is, if you think about it, the only people ever to mention the words impulsive and corrective before were Elliott wave traders. But the thing is that they never really went out and defined what does an impulsive move look like? What would the candles look like? They kind of described the overall gestalt of what it would look like, but they stopped short on being able to communicate and define what that would look like in the price action. How could they break it down into variables that if you were to spot these three variables, it would always be an impulsive move. And if you were to spot these other three variables, it would always be a corrective move. So let's go ahead and define these variables really briefly so that you can understand. But just to kind of give you an idea, an impulsive move is a move where there's a high level of imbalance in the market, in the price action. And so if you think about that, that communicates force, that communicates speed, that communicates kind of a power behind the direction. And so when you go to define that, how do we define that in terms of the candles? How do we define that in terms of the price action? Well, these are three variables that you can use to always define the move, whether it's impulsive and corrective. So the three underlying characteristics of an impulsive move is one, let me zoom into a section here, the majority of candles are going to be one color. Now, why does this communicate a level of imbalance? If the majority of candles are one color, like take this move from here down to here, it's 4 out of 5 red candles, regardless of the size, what is that communicating to us over time? It's communicating to us over time that as each candle closes, the order flow is dominant enough to continually close the majority of times in one direction. And the only time that happens is when there's a relative level of imbalance in the market. You know, we'd have to be over 60% on the buy or sell side to have that kind of level of imbalance to create a strong directional move, especially one that is consistently over time printing candle after candle after candle after candle. So communication through time is a direct communication of the level of balance or imbalance in the market. And so when we have the majority of candles in one particular direction, that communicates imbalance to us. And we like that if we're on the bear side in this case. So that's the first characteristic. The second characteristic is the size of the candles. Impulsive candles, if the market is more biased or it is more imbalanced to the sell side in this case, then the larger candles should be towards the sell side. because there's more order flow plowing in that particular direction. It's one thing if we have a one-time move where the market stopped out a bunch of like say bulls in this case, and it produced a couple big candles, and then the market fizzled out after that. But it's another thing that when the market continues to create, bigger candles on the sell side again and again and again, it tells you that through the amount of order flow and imbalance, they're able to stretch the candles longer. And so anytime you see a stretch in the candles, that actually communicates imbalance in the order flow. So that's characteristic number 2. The larger candles are towards one side of the market. The third characteristic, it has to do with closes. So in general impulsive moves, the majority of closes are not going to be towards the middle. They're going to be towards the lower quarter, lower third of the candle, sometimes on the actual lows. Now, why does that matter to us in terms of how we read the price action? Because when the market continually can close on its lows over a specific period of time and continue to do that, that tells you that there's no profit taking and that there's no pushback from the market. If there was a solid pushback from the bear side anywhere in this move, we get a little bit here, but if there was, then we would see that reflected in a wick to the downside. We would see that as the market pushing more towards the middle or pushing even back to where the market opened. We're not seeing that. If you look at just this move right here, the majority of closes are in either on the bottom, the absolute lows, almost the lows, pretty much towards the lows, a little bit more, 1/3 in, now we get an ejection, one final exhaustion candle, and then that's it. Same thing for this move down here. Same thing for this move down here. So these 3 variables can always help us to identify an impulsive move, and that becomes very favorable to us. And if you think about it, by implication, that communicates a lot to us in terms of our current trade. If you're thinking about you're getting that kind of itchy finger to kind of take profits, but yet you're seeing that the market is closing on its lows consistently, the candles are consistently in your favor, that should be a direct communication. No, I should be riding this trade until I start to see that wane. That is a direct communication from the price action about the underlying order flow behind it. So there are many implications, and I teach many more of those to my members, but that's just to kind of give you an idea. And so if you've ever been wondering, wow, I'm in this trade, the trend is running really well, should I be getting out? Well, if you're continually seeing impulsive moves in your favor, and you see candles stretching in your favor, and you see closes towards the direction that you are trading, then the answer is no. You should be lifting your limit and allowing that to continue. So, any brief questions on that before I move on to corrective structures? Frank B says, at the end of the day, you're on the hard rate edge of the chart and you have to ask yourself, are we in a strong or weak momentum, or is it ready for reversion to the mean? Believe it or not, Frank, you wouldn't believe how often I get asked this question. And the question is an interesting one to me because it presupposes that while it correctly presupposes that the next candle can be anything, it can communicate anything, there's an underlying hint in your question saying that, sure, it's always easy to detect impulsive moves or it's easy to detect things after the fact, but how about before the fact? Well, I make my trades based upon these models, and I do this all the time. And what am I doing? I'm not trading certainty, I'm trading probabilities. And I'm using the price action context to hint at a level of probability. There is no certainty in the markets. There's absolutely no certainty. There's only probability. This is all professional traders know this. You can't look for certainty in the market because there isn't any. It's based on a relative amount of uncertainty and unconditionality. And so with that being said, you're asking the question, well, how can you know for certain whether the next move is going to continue or not? You can't. But what you can do is trade probabilities. And what you can do is take trades or keep your trades based upon the probabilities that are available in the market. And so with that being said, how do we determine whether something is favorable, more probable to moving towards the buy side or the sell side? Well, we use price action context. We use the sum total of the price action context, and one of the models that we use to detect this is impulsive versus corrective. So your question, Frank, is something that a lot of traders who are looking for certainty or who haven't built up the confidence to trust and trade probabilities, usually when a trader has built up the confidence to understand that the market is probabilities and you're just trading probabilities that are more in your favor than less, then that question goes away because it's no longer a question of certainty, it's a question of probabilities. You know, this isn't Texas Hold'em poker where we know the amount of cards on the table. It's a different story. So to answer your question, we look for probabilities that are favorable via the price action context, and this is one model to determine that. So I'll explain to you later on in this lesson, or as I progress on this lesson. Let me progress a little bit further. Let me describe corrective structures, and then I'll start to discuss some overall patterns within the impulsive and corrective structures and the price action, and how you can use that as kind of a predictive method to say, hey, look, this context shows me that it's more favorable that the market is going to move in this direction or this direction. So let me progress on and we'll start to get into that. CL, your question, no, it's not a 50 MA, it's a 20 MA. The rest of these questions here, so let me, Sina and Deborah, let me get to your questions as I finish up the corrective model and the other portion of this lesson, and then we'll start to get into these particular questions. So to review real quick, an impulsive move has three characteristics. Large candles, largest candles are in that particular direction. Closes are towards the high or low in that particular direction, and the majority of candles are that particular color. So that's an impulsive move. A corrective move, once you've understood impulsive move, a corrective move is very easy to define because you just take those variables and you invert them. So what do I mean by inverting them? Well, if the candles are large in an impulsive move, what would they be in a corrective move? What would be the opposite of large candles? It would be small candles. So for example, we have a really good impulsive corrective series here. Impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive. Look at the corrective moves that I've kind of defined here. What do you see? Smaller candles. So that's inverting characteristic number one. Instead of large candles, it's small candles. Are the majority of candles in this section right here one color? No, they're mixed. That's communicating over time. That's the order flow communicating over time. There is a relative balance within this zone here because it's oscillating between bull and bear candles. So that's characteristic number two. Instead of the candles being one color predominantly, they're more of a mix, 55-45 or 50-50. And the third characteristic is that the majority of closes are going to be towards the middle, not towards the highs or lows. And you can see that in this particular corrective move here. You can see it in this corrective move. There's many others we'll show you later on. But when you look at any corrective structure, that is how you define it. So now with these definitions, you now have clear ways that you can look at the price action on any instrument, any time frame, any environment, and determine to a fair degree of probability where is the level of imbalance and imbalance. Is the market balanced right now? Then it's in a corrective structure. Is the market imbalanced right now? It should be displaying an impulsive structure. So this is just one of the models that we use to detect the underlying order flow and detect the level of imbalance and imbalance. Any questions on a corrective structure before I move forward? Excuse me, I'm going to delete some of these other questions here. Okay, it doesn't look like there's any more questions. So let me zoom out a little bit and talk about a particular trade I'm in right now on the dollar yen. And so for the year, I've pretty much been shorting the dollar yen the majority of the year. And so what was my basis for shorting the dollar yen the majority of this year? Let me zoom out a little bit, refresh that. Okay, we do actually have a question about the impulsive corrective structures, so we'll answer that before I move forward. So Mithun says he has a question here. In impulsive structure, also we get big candles. Yes, you're supposed to get big candles in impulsive structure. So I'm not sure what the question is about that one. In a downtrend, the large bar should be closing at the lows and impulsive bar, right? Not the high. The majority, that's correct. So the majority of in a downtrend, the majority of the candles, at least in an impulsive move, should be closing towards the lows. And what do I mean by the lows? Usually the bottom quarter, the bottom third. If you think about it from an order flow perspective, if we have a daily candle and it opens and then it pushes down to begin with, but then all of a sudden the buyers start to push back and retrace some of the gains that the bears had taken for that day. Okay, well, how are the bears able to do that? They're going to have to be able to absorb the buying pressure. They'll have to be absorb it with more liquidity and stronger orders than the sellers are in this case to be able to reverse it. Now, if within a day we start off, say, on the highs and we just start selling from the open, and then what happens, we hit a particular low and we start to bounce back. Once you start bouncing back and eating 50, 60, 70% of the gains on that particular candle, that's communicating, at least for that period of time, that while the candle initially and the order flow initially started off on the bear side, that the bids were able to absorb the offers. They were able to absorb that momentum, and the only way you can do that is with greater strength and greater momentum. And so if you're able to recover that with a fair amount of strength, then that means that the bulls in this case, or the bids, are able to absorb the offers with a certain amount of force. So that's a very good question. Okay. So Mithun, I'm not sure I understand how do we understand that? Could you please elaborate? Matthew, I'll give you my website address at the end. Goes to Perhaps you can type out your question a little bit more, Mithun, so a little more elaborate so I can understand it. David has a question here. Does the time frame matter, or is it better over longer periods? This is a great question. So if you think about it from kind of an overarching perspective, trend is only defined by the time frame. The trend on one particular time frame can be the same, it can be the opposite, or it can completely neutral towards that particular time frame. Trend can only be defined on that particular time frame. So in terms of, does this work on any particular time frame? Absolutely. I trade every time frame from the 1 minute up to the daily. And if I'm trading intraday, you better believe I'm paying attention to these principles. There is never a situation where I'm not paying attention to the price action context, particularly the level of imbalance and balance via the impulsive or corrective move. If you're trading the 1 minute, 3 minute, 5 minute charts, doesn't matter. So, all right, Matthew, here you go. That's my website. So intraday trading doesn't matter. Swing trading doesn't matter. Position trading doesn't matter. It doesn't matter. Instrument, time frame, environment. This works on any time frame, any intraday environment. So hopefully that answers your question. Any other questions around that? Okay. All right, great. That covers that. All right, great. So fantastic. So let me kind of get into why I've been bearish on the dollar yen, why I've been pretty much selling it in fact, I can't even remember the last time I bought the dollar yen this year. I might have bought it like 1 or 2 times this year, but ever since the big sell-off in January, I have been doing nothing but selling the dollar yen. In fact, I'm short it right now. And I'll explain where I'm short, why, what was my stop loss, what was my take profit, what was the whole model behind, how was I using price action context to understand this trade, and how you can use this, and what are some of the ways that you can use this. So this right here is the beginning of the year, right there. And so if we zoom out a little bit, what do we see in terms of the dollar yen? So this is what I see in terms of, or what I'm seeing in terms of the dollar yen this year, going into that. I saw, I mean, you're talking a massive bull trend for a long period of time. You're talking the low 90s up to 125. That is an impressive move. And so dollar yen had been bullish for a few years straight. And then towards the end, or pretty much for the last year, it's been correcting in a large 1,000 pip range. And so we have kind of a stable support zone here. But anytime I see a large level of imbalance or a large level of balance, then what am I doing? I'm trading that balance, but I'm doing it with a greater bias towards the current with trend players. So how the market enters that level of balance in that balancing zone is the people who were in control prior. And in this case, it's very clear the bulls were in control when heading into this balancing zone. But some interesting things started to happen to the dollar yen as it started to kind of make a new set of highs. The impulsive candles to the bear side started to increase. We had 4 days of selling that completely wiped out months of buying. And then as we try to make a new set of highs, we start to see again red candles and impulsive moves starting to take over. January comes, it starts off selling, has a brief period of buying, and then aggressive, impulsive selling to wipe out a year of gains. So when I have 2 weeks of selling that wipes out a year of gains, that's either some sort of panic move or we have a complete change in the order flow behind the market. To take out all these with trend players who have been supporting this market for years, all the people who had buy orders here and here, to clear them out and never come back to this level tells you that the sellers have taken over control of the market. And so once we had that kind of big sell-off, I have been selling the dollar yen ever since. So let's get into what I was seeing in terms of the context and the structure using the impulsive and corrective structures. So here's the impulsive selling pretty much middle of the month, end of the month to start the year. It wipes out a year of gains. And what do we have here? We have an impulsive move that's predominantly all red candles except for one blue candle. Then what happens since then? We form a corrective structure. It's a mix of red and blue candles. Now, imagine you are here. I wrote about this ahead of time. We got to, I think we're about here and I wrote about this. So just looking at this structure, and let's zoom in a little bit. Was there any clues, as Frank has a question, when you're trading the hard right edge, how do you know? Well, you don't know, you only have probabilities. Here's that same corrective structure. I love corrective structures like this. These are some of my favorite structures to trade. I will trade both sides of the market, but I will have larger positions on the sell side because that's where the market entered and that's with the trend. And so, were there any clues inside this corrective structure that the market might be breaking down ahead of time? I wrote about this ahead of time, but does anybody see anything in here? So this is where you are right now. This is the hard right edge. Any guesses? Wayne said lower highs and lows. That's part of it. There we go. Victor. Victor's a member of mine, so he's kind of cheating. Okay, Remember how I talked about that we use that price action or order flow is the most proximate driver of price action, and the level of imbalance or balance will reflect itself in the price action? Okay, so if we think about it, if the market is highly imbalanced to the buy side, we'll see strong vertical moves. We'll see very strong vertical moves. And so we see that here. We see a very strong vertical move. Let's look at the next one. Again, very strong vertical move. There's really strong buying off the 111 level. Part of the reason was there was actually a lot of corporate hedges around 110, but we'll get into that later. But then look what happens here. The angle on the bounce weakens tremendously, which I wrote about ahead of time. Now, if you think about it in terms of order flow, if the angles of prior bounces are strong but then they start to weaken, would that represent greater imbalance to the buy side or greater balance between the two? It would show the imbalance is weakening on the buy side and that the market is more balancing. So when the angles flatten themselves out, that's not imbalance, that's balancing. That's showing the imbalance is weakening to the buy side. When angles stay strong, this is strong order flow creates strong thrusting moves. Weak order flow creates weaker bounces and weaker angles. So this was a direct communication from the order flow and the market. Hey, we've bounced twice off this level, and it didn't take us that much to get us up to 114. But then here, all of a sudden, it takes weeks to get us up to 114. And we can't do it with the same level of force. So the force and the angle are communicating through the price action what the underlying order flow is in the market. Usually, when angles weaken inside of a corrective structure, there's a good chance that the market is going to break in that direction. I've written about this many times. I've called many moves ahead of time just based on this alone. So once we had this kind of breakthrough on the dollar-yen, if we look at it from a larger structure, what do we see? Impulsive, corrective, impulsive selling. So I want to be selling until this balance zone is taken out. I'm bearish until this zone is completely eclipsed. Until we can get above this balancing zone on a daily closing basis, I'm bearish on this pair. If I'm going to trade it 100 times, I'm going to be selling between 75 and 90 times out of 100. Now, any questions based upon the angles? I wasn't planning on talking about angles today, but I did. Any questions on what price action is communicating in terms of the order flow through the impulsive versus corrective model? Any questions on that? Okay, doesn't look like there's any questions on that. Okay, so a couple more things I like to communicate. I only have about 10 more minutes. So a couple more things I like to communicate. Corrective structures are, somebody say 10-minute warning. Okay, great. Thank you, Renee. I appreciate it. So corrective structures come in 3 different flavors. And if you can think of a corrective structure as a balancing zone. Large ranges are just large balancing zones. So corrective structures can either be horizontal, they can be with trend, which means there's like a minor bleed to the downside, or they can be counter trend. Those are the 3 types of corrective structures that the market will present to you. Now, corrective structures counter trend, they can generally represent one of 2 things. They can represent a level of profit taking from the with trend players. Usually profit taking will result in some sort of bounce, but the level of profit taking that happens and the level of order flow that have been dominant in the market, like if the market is heavily to the bear side, as it has been in the pound dollar for a long period of time due to the Brexit situation and all these other risks that are happening with that. So a lot of people have been trying to sell the pound in various ways to kind of hedge against a possible Brexit. So with that being said, when the market is heavily imbalanced, if a lot of those players are going to be taking profit, then the profit taking will produce a decent sized bounce. But when the profit taking produces a very mild bounce, then that should be a very direct communication that the opposite side of the market really doesn't have any capacity to push back on the with trend players, and that the only reason why this is kind of bouncing at all is mostly because the with trend players are unwinding some of their position. So we have to understand that corrective structures can present counter trend moves, and just because that happens doesn't mean the market is turning against us. If you're a swing trader, you know, and you had sold anywhere between here and say here, or maybe even sold on the break of, you know, this corrective structure, maybe you sold on the break of this corrective structure here, maybe even caught the pullback on this one here to this pullback towards the base of the prior corrective structure. Any one of these low trade locations, that if you see a large corrective balancing zone, then as a swing trader you should be trading on the other side of this structure. And with that being said, until this structure fails, you should be bearish. Now the fact that we've actually broken out of this corrective structure means that now this corrective structure is your defense. This is the major structural defense that most with trend players are going to be using at this point. So until this is cleared on a daily closing basis, I'm bearish. I intraday and swing trade the dollar yen, and until this is cleared, I will keep selling the pair. So it's important to understand that corrective structures don't necessarily mean it's like the end of your trade. If you're a momentum trader, corrective structure should mean the end of your trade, because you're just trying to capture as much of the impulsive move as possible. As soon as the market goes corrective, depending upon how it goes corrected, should communicate whether that momentum's dissipated or it's just a temporary pause before the market breaks down in your favor again. So we can use corrective structures as communications for us. If we're momentum traders, it's time to take profit. If we are swing traders, it's time to trail our stop and lock in more profit. If we're breakout traders, corrective structures are not the things. Once you see a corrective structure, it's kind of like a momentum trader. You should be, in most cases, looking to exit at that point. Okay, so I know that's a lot of information there, and it's 45 minutes. I could talk about impulsive corrective structure for hours. In fact, I do that with my members. But let me, I only got about 5 more minutes, so let me just process these last okay, let's see here. Okay, Timothy has a question. What does the moving average tell you? So the moving average is what I generally look at that as kind of like a secondary communicator of information. I can trade without the moving average. I can just trade pure price action. I'm mostly interested in the moving average on if there are particular pullbacks into resistance levels, support levels, role reversal levels, corrective structures, and the 20 EMA, that's what it is, that blue line's a 20 EMA. When that's kind of matching up, that to me enhances the strength of a signal. It's not, if it's not there, that doesn't mean I'm not taking the signal. I just kind of look at it as an extra piece of information that's useful. When the market is far away from the 20 EMA, that communicates a mathematical imbalance. The only way you can be, the price action can be far away from the 20 EMA is when there's a high amount of imbalance in the market. So there are many things that it communicates to me, and I could spend hours talking about it, but those are just a few things right there. Wayne L is the middle area of a corrective area POC. You're going to have to clarify what you mean with it. I think that's from another terminology or methodology, but if you can clarify, that'd be great. Shyamala Trader says, we can check angles compare with prior angles. Yeah, so angles is very useful in the price action, particularly when we have large balancing zones or or just corrective structures as a whole. And so anytime the angles are weakening, then that is telling you that the order flow is changing. If there was no change in the order flow and the balance was equal on both sides, the rejections would be relatively the same and stable. But if one side of the market is taking over the other, then the angles should start adjusting. So that's a communication. Mithun says, please give your motivation, thoughts, trading style, and pips you take each month. That's kind of a question outside of this, my motivational thoughts and trading style. I have communicated my trading style. That's within the context of this. I trade price action context. Okay, any other questions here? Mark has a great question. Would fundamental or geopolitical news distract you from your initial thoughts and plans on trade while looking at the current price action other before you take a position you're already in trade? So other than if I'm intraday trading, I am aware of a few key events, but if I'm swing trading, I'm not too concerned about the geo or political or fundamental events, because the bottom line is that those events have to be interpreted, and once they're interpreted, then they're going to lead to a trading decision. And that's either going to be people who are in the market who are going to add on to the position, they're going to hedge their position, or they're going to neutralize their position. And it's also going to affect people who are not in the market. Either they're going to stay out of the market even further, they're going to get into the market, or they're going to plan for future scenarios in the market. It doesn't really matter to me what those events are happening. They don't distract me, or I don't use those as methods to get into the market, because the bottom line is that that information has to get turned into order flow. Otherwise, it's just potential liquidity that's not actualized. Once those orders become actualized, it will then turn into order flow in the market and therefore affect the price action. So I will use that and how the market responds to that information as a communication to me. Am I aware of certain things? Sure, I'm aware of, Brexit, I'm aware of major things, but I'm not like scoping and scouring the earth for every piece of information, which is impossible to get, or to find, there is no correct interpretation of a fundamental event. It's what does that interpretation, what does that event mean to you? And everybody has their bias. I don't really care about that. What I care about is how do actually people decide to get in and out of the market based on that information. And they're going to do that via the price action and order flow. So hopefully I answered your question. Yes, Timothy, it's a 20 exponential moving average. Fred's saying London breakout as well. I'm not sure what you're referring to in terms of London breakout. That's not a particular strategy I trade, but again, this works on any instrument, time frame, or environment. Wayne, I don't trade market profile. There are some similarities, but I don't use that as a point of control, and I can't say I always agree with that. I trade price action, context, and structure. Okay, any last questions here? Probably not. I know I have to be wrapping this up right now, so there's so many questions here. I'd love to answer them all. But with that being said, real briefly, so this right here of what I just communicated to y'all is just a fraction, and I'm talking a fraction of what I teach in terms of price action. I have an entire course dedicated to price action. It's my advanced price action course. And this is the first lesson in my price action course. So you can imagine what kind of lessons we stack on top of this once we evolve the concept further, and what this can do for your ability to read price action in real time. I'm making my trades just as everybody else is. I'm making my trades with the same right edge that everybody else sees. It's not like I get a different one. I get the same one you do. I mean, and so with that being said, when you learn to read price action, particularly price action context and through these models, you can start stacking the probabilities in your favor. You can start trading with the order flow instead of against it. And so my site is secondskiesforex.com. This is my site here. This is my price action course here. You're welcome to go to my site here, which is, there you go, secondskiesforex.com. And so I'm actually going to be launching a V2 of my advanced price action course. It's got 60 lessons in it. I've put over 1,000 hours building it. And I have about, right now I have about 15 to 20 live trades. I've actually recorded live trades showing, hey, this is my account. You can see it's a live trade right now. I'm trading with real money right now. This is my account. Showing you exactly how these strategies work in real time. There are very few courses. I can't really find any courses out there where they actually explain the concepts with their real trades. And that's what I've done. And so I've spent 1,000 hours putting my neuroscience background, my meditation background, my trading on Wall Street, trading for a hedge fund, trading as a broker. I put all that into this course. That's launching at the end of this month. And so whoever joins before that gets access to the new course for free. Once the new course launches, price is going to go up. Now I've created a special coupon code for members of this particular webinar, and people are watching the recording, and it will last for 2 weeks. And so the code is FPA10. Doesn't have to be in caps or anything, and I'll type it in. And that will give you a code to get a 10% off of my current course. I hope you do join, because once you join after, not only is the price going to go up, but you're going to be wishing you got in for the cheaper price and got access to the same material. So that's pretty much it. I have a ton of free content on here explaining more stuff about my price action context, videos, examples of live trades, me using the same concepts. I do weekly commentary, I do market commentary, and I have a members area where all my members, thousands of members, are posting their trades in real time, asking questions of me, analyzing my trade ideas. I do ongoing member webinars for them. So if that's interesting to you, check us out, secondskiesforex.com. You're also welcome to email me directly, chris@secondskiesforex.com. So I think that's pretty much it, and I've run out of time, so I want to thank MTI for this, and I want to thank those who presented the webinar. Thank you all very much. I hope to hear from you, and I hope you all enjoyed this material, and I hope to hear from you again. Take care, everyone.